Hello, everybody! This is Brad Reed, your real life trader, and I'm here reminding you to be good. And by good, I mean get out of debt and achieve your financial dreams. Hello, everyone. Hope you're doing great. This video is Do You Invest Like It's Pre-1970? This was requested by a real life trader by the name of Margit. Margit, thanks for reaching out to me and telling us how we can enrich your life. So enjoy the video. Before I continue, the lawyers out in Los Angeles want me to remind you that this is a broad-based investments and generalized information. It is not specific to each and every single person that is going to view this video. If you seek individualized or customized advice, please find a competent professional in your area. Just wanted to remind you guys of the plethora of videos that are on the Real Life Trading website. You can find those at www.reallifetrading.com. And this is just the financial fundamentals and bonus videos. Under the stock trading videos, there are 20 or 30 some odd videos there teaching people how to trade stocks, whether you're a beginner or a professional, whether you're interested in day trading, all kinds of stuff. Be sure and check that out. In this video, I'm going to compare what stock trading was like in, say, the 1970s and 1980s to what stock trading is like today. Because if you were using the strategies that worked in the 70s and 80s and 90s, you could be missing out on huge returns by using those strategies today. There are much better strategies to use in today's market with today's technology, with today's information, and in this video I'm going to talk about the difference. Now, if you do like buy and hold investing, or buy and hope as many people call it these days, there is a good way to do that, and I'm going to show you briefly how to do it, and then I'm going to show you where you can go get free education on how to execute these strategies. So let's take a look at the market. This picture shows the Dow Jones from 1950 to 2014. The blue box is the area where I'm saying that was a certain set of trade strategies worked then, and in the green box, those same strategies would cause you to miss out on huge opportunities, would cause you to ride a wild roller coaster, and there are much better strategies to use in the green box than in the blue box. So let's talk about it. Let's say it's 1950, 1960, 1970. What is the stock market doing? Well, it's just kind of going up and up and up, and it just keeps going up. So the best way to invest is to just buy something and hold it because, you know, things have been going up for 10, 20, 30, 40 years. So what do you think it's going to keep doing? It's going to keep going up. If there were any little hiccups, they were extremely short-lived. And then there's this big one over here. 1987. Remember the crash in 1987, and oh my gosh, people were scared, and it was terror, and the sky is falling, and Armageddon is coming, and it was horrible. But look how short that was, 2 years, and we got right back to where we were before, and then the market kept taking off. This is about the time where mutual funds really started getting popular, because in a mutual fund, you could buy into the fund, and the fund represented a broad diversification of stocks. And it was always going up. And, you know, buy and hold worked. Mutual funds worked because everything was going up. But then when the market started going down like it did in 2000, mutual funds all of a sudden were not the answer. And I was completely convinced of this fact when I saw the numbers. In 2011, the S&P 500 did 0%. It was flat. But out of 3,560 some odd mutual funds, only 29 were positive. So if a mutual fund is supposed to be so great, and if there's, you know, if we're paying big bucks for the mutual fund manager to be getting us into the good investments, why the heck were only 29 out of 3,568 mutual funds positive? They should have all been positive if the market was flat. And this is just one of many reasons why buy and hold, I feel, causes you to miss out on many opportunities. So what happened in the green box? Well, in 2000, the market started diving. And if you look how severe that downturn is compared to anything that we had seen in the last 50 years, it was shocking. just completely terrifying for investors. And then, what the heck is that? From 2003 to 2008, the stock market saw the most unprecedented, most rapid growth it had ever seen before, ever. And all of a sudden, everyone's like, yay, hooray! The stock market's going to go to the moon. It's going to go 250,000 miles above the screen or whatever. But then in 2007, we had a correction again. And this time it was huge, even bigger than before, much bigger than before. And everyone that was relying on retirement funds, remember this is when the pension funds were folding. A pension is supposed to be guaranteed. That's what they pitch it as. They say you should invest in your pension fund because even though you get a horrible 5% rate of return, it's guaranteed. But these pension funds were closing right and left, and actually we took taxpayer dollars to pay for some of these pensions to save some people. But some people were just like, okay, I've been putting money in this pension fund for 40 years, and now it's gone. Again, the buy and hold in those strategies that worked in the 50s, 60s, 70s, 80s, and 90s, they did not work after the year 2000. And then in, I think it was March of 2008, again, the market has just taken off. But look at the angles in the green box. Look how big those arrows are. Look how big those swings are. And look how steep they are. And compare that to everything in the blue box. There is nothing like it. Investing in the year 2000 and 2014 is just completely different. It's a completely different animal, and you got to use completely different strategies. Now, on top of that, in the green box, we have this really cool kind of funky tool called the internet. And yeah, the internet was usable in the 90s, but it wasn't anywhere near what it was today. If you were in the 60s and 70s and you wanted to research a stock, you pretty much had to go to the library or the newspaper, or you looked it up in books. If you had information that was 3 months old in 1960, that was brand spanking new, hot off the press. Well, compare that to today. If information is 3 months old, most people are like, wow, that's pretty much worthless. What the heck are you doing with that? Go to the internet and find out what happened a second ago. Find out what happened an hour ago. Find out what happened yesterday. And trade fees. To get into a stock in the 1960s, 1970s, trade fees were huge. I've read somewhere around 1 to 7%. So the only way to recover your loss from just getting into the position is you had to hold it for a while. Well, now in the green box, trade fees are $5. I've even seen $1 to buy a whole bunch of stock. So the time it takes to recover the cost of the trade fee is extremely, extremely short. And then let's talk about how you execute the trade. In the times of the blue box, you had to go to a stockbroker and you had to call them up and you had to say, hi, I would please like to buy so many shares of such and such stock. And then the stockbroker said, wow, that's great. I'll pass that order on, and then someone else here at the company will make a big stack of them, and then someone else will take that on to some other person, and that person will then call down to the trading floor, and then that trading floor will execute the order, and you'll get a confirmation sometime. But to actually execute the trade took a very, very long time. Again, compare that to today. You go to the internet, you push a couple of buttons, and bam, you're in instantaneously. So if you were to buy and hold during the green box, you're just completely missing out on some huge opportunities, namely those red opportunities. What if you had strategies that made money when the market went down? You made money when the market went up. You made money when the market went down again. You made money when the market goes up. And when, not if, when we have the next huge red arrow, you can make a whole bunch more money again. Well, if you look at the decline from 2000 to 2003, let's say you had a strategy to make money. So I'm going to take that arrow and I'm just going to turn it upside down. And then the market from 2003 to 2007, we have money to make money there. Those are the same orange arrows. And then in the reversal in 2007, let's say you made money during that because you had a flexible strategy and you went into bearish positions and you made money. And then in the current bullish market, again, you switch and you made money. You're off the screen. Look at this, folks. If you had proper strategies, not buy and hold, but proper strategies from 2000 and 2014, you would have made more money in 14 years than in the last 64 years of the entire market. Think about that. In 14 years, you can make way more money than buy and hold over 64 years. That's why you got to learn the new strategies. You got to learn how to invest like it's the year 2014. All right, so to quickly recap why I believe that there are much better strategies today than using the same strategies of yesteryear was that we've talked about the market behavior. In the 1900s, there was slow and steady bullish upward movement. Any bearish move was quick and over with in a heartbeat. And today, there's these huge bullish bubbles. We have fast, severe, bearish free falls, and everyone is scared of when the next one's going to happen, and it causes people to jump out of trades and jump into bearish positions when they really shouldn't be, and then they jump back into bullish positions, and it's just a wild market today compared to the 1900s. Information was difficult to get, and it was almost always old and out of date in the 1900s. Today, you can get up-to-date, up-to-the-second information just about anywhere you go. I get alerts on my cell phone. I know a lot of other people do, where your cell phone will actually ding and you'll get a text message and it'll say, hey, there was just some news on such and such stock, or such and such ETF just marked a new high or a new low, but the point is you can get information instantaneously anywhere with laptop computers and smartphones and the new technologies. Trade fees were huge in the 1900s, so you were forced to hold on to your investment at least until you broke even on the trade fee. Well, today trade fees are $5. I know one brokerage company that charges $1 to get into stock positions. So you don't have to hold for days and days and weeks and months and maybe even years to break even on your trade fees, because you can break even on your trade fee in a few seconds to a few minutes. It took a couple of days, 1 to 2 days in the 1900s to get into your position after you had made the decision to get in. Today, it's instant. Less than a second. You push the button, you're in. Done. Options are a form of insurance. Options and insurance on your investments in the 1900s were very, very expensive because no one was buying them because the market was always going up. Well, today, options are very inexpensive. There are tons of choices. And I've talked about options as insurance. I'm assuming everyone here that's listening has insurance on your house. You have insurance on your car. You may have insurance on some of your expensive items in your house. I know I've got insurance on a piano and some other things. Do you not have insurance on your investment, on your retirement account? Check out options. Options were designed to be insurance on your investment. Go to www.reallifetrading.com, watch those stock trading videos, and we'll teach you how to get insurance on your retirement account. It's pretty cool. So useful strategies in the 1900s, pretty much it was buy and hold. Why? Because it worked. Why? Because of everything that we've talked about, all those conditions in the 1900s, buy and hold, it worked in the 1900s. But today, there are so many better strategies that can take advantage of upward swings and downward swings, and day trading and swing trading and position trading. Day trading is, holding for a couple of minutes to a couple of hours. Swing trading is holding for a couple of days to a couple of weeks. Position trading, a couple of weeks to a couple of months you're in a position. But the whole point is the strategies today allow you to get out when the reversal happens, and you can get into bearish positions that make money when the stock market goes down. So again, strategies today, much more useful. You need to learn the new strategies. Quit using the strategies of the 1900s. Now, buy and hold in 2014 works well if you know how to sell covered calls. Just by selling covered calls, you can boost your returns, sometimes 1% a month, sometimes 3% a month, sometimes more. And you can buy protective puts along the way to guarantee to lock in your profit. So let me say that again. You can buy a stock and hold it. You can sell covered calls to generate an extra 5 to 36% per year. While you're doing this, you can buy protective puts. You can buy insurance to lock in the upward movement that you've seen in the stock so far. Sound too good to be true? So let's say you were a buy and hold person and you wanted to buy and hold and use the strategies of 2014 like I've been talking about in this video. What you're seeing here is the Dow Jones from 2011 to the present day, and I'm going to show you how you can get free investment insurance. And the way you're going to do that is you're going to sell a covered call and use the money from that covered call to buy a protective put. This is called a collar. And the strategy's been around for a really, really long time, but not many people know about it. And I have no idea why people don't know about it, but that's why real life trading, our mission is to enrich lives. So I'm going to teach you the collar strategy. I'm not going to teach you, I'm going to demonstrate. Go to www.reallifetrading.com, find the videos there, and we'll teach you how to do it. All right. So let's say towards the end of 2011, you see that we are making a higher low. Then we make another higher low. And then you see this big, huge white candle, and you say, hey, I want in. That's a bullish indicator, and so I'm going to buy, and I'm going to buy right there. Well, shortly after you buy, it keeps going up, 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 up. And then around March and April of 2012, it kind of goes flat. And you're starting to think, is this a continuation pattern, or has the momentum died out? Well, I'm not going to risk it. I'm going to sell a covered call, and I'm going to buy a protective put, and so I'm going to get free insurance. I'm going to sell a covered call, and I'm going to buy a protective put to lock in what I've done so far. So when you do that, you're going to, where that blue line is, that's your get out line. So if for some reason the stock were to go below that, you're going to just close out your position. The green line is the level at where you sold your covered call. If the stock goes above that green line, it's likely going to be called away. You're going to have to sell it. But you will make the profit from the green line to the blue line, and you get to keep the premium that you got from selling the covered call. If the stock goes below the red line, you've got two choices. You can sell the stock at the red line, and then you get to keep the money that you made from where you entered to the red line, or you can sell the put. That put is worth money. And because the stock has not yet gotten to the blue line, let's say you watch it cross below your red line, you're thinking, oh, my put's in the money. I don't know if I'm going to sell the stock or if I'm going to just sell the put and make a couple of bucks on that. But then you see that big white candle before it expires, and you say, I'll just sell the put, make some money. I think the stock's going to keep going up, and lo and behold, it does. So you adjust your get out line, and you've just about guaranteed to break even, and you see it go sideways again towards the end of 2012, and so you do another collar, sell a covered call, you buy a protective put, and it does kind of the same thing that it did before. It goes below your protective put and reverses. So you keep the premium from your covered call and you sell your put and you make a little bit more money. The stock keeps going up, so you adjust your get out line, and now you are certainly above where you got in. So again, you're locked into a profit, and it keeps going up for months and months. And then it goes sideways again, and you see that it has this this high-legged doji candle and then a big black candle, and you're thinking, okay, that might be a reversal pattern, so I'm going to do a collar. So you sell your covered call, and you buy your protective put, and the stock goes down below your put, and you get a big reversal pattern. So you sell your put and make some money, or you at least break even on your put. And now, in this picture, the way I drew it, you might have gotten exercise. You might have gotten your shares called away, but your profit is from that top green line down to the purple arrow where you got in. But if that call expired worthless, you're still in, and you move your get out line upwards, and you increase the profits that you've locked in, and you keep doing the collar, and you keep doing the collar, and you keep doing the collar, and you keep doing the collar. This is free insurance because you buy the protective put with the money that you get from selling the call. If the stock goes up above the call that you sold, it gets called away, but you still sell the stock for a profit. If it goes below your protective put, you can exercise your put, and that gives you the right to sell the stock at the strike price of your put, which is a profit, or you can sell the put for a profit and hold on to the stock. There's So many different choices. It's like checking the weather report and you see a storm coming, and so you call your insurance company and say, hey, storm's coming, I want insurance on my house. And then the storm passes and you say, hey, I don't want to pay for insurance anymore. Uh, and then another storm comes, hey, I want to buy insurance. It's bouncing in and out of insurance based on the weather of the stock market. The next step is to go to www.reallifetrading.com and learn how to do the strategies that work in the new millennium for free. You'll be able to improve your returns vastly over your buy and hold strategies. Practice trading in a virtual account. Some stockbrokers allow you to set up an account and trade with fake money. And you can trade real stocks with real prices, but just with fake money. So if you lose on a trade because you're experimenting with the strategy, so what? It's just pretend money, and you can get it back just by typing on your keyboard. Pretty cool. I like to tell people, do not trade real money until you can trade profitably with your fake money account for at least 3 months. And be patient with yourself. You're learning a skill. Like learning how to swim or learning how to ride a bike. It's going to take a while to do that. And just like you learn to swim in the shallow end of the pool, you're going to learn to trade stocks with fake money. Folks, I hope this video has enriched your life. I certainly want to thank Margit for requesting the video. If you would like to request a video, send me an email, brad@reallifetrading.com, or go to our Facebook page and request whatever you want, from things about getting out of debt or budgeting or some stock trading strategy that you want to learn. Post it on there, send us an email, and we'll do our best to get that out as quickly as possible. Thank you, everyone, for watching this video. Again, my name is Brad Reed, and I'm here to remind you to be good, and by good I mean get out of debt and trade on logic, not on hope. Thank you.